Welcome to the Retiring Real Estate Investor Podcast, where we will discuss how to defer taxes on the sale of your property, earning passive real estate income, and everything you need to know to go from active investor to passive investor. Join us as we interview passive investment sponsors, explore the journey of other retiring real estate investors, and share our due diligence process we perform to select passive investments. Investment advisory services provided by Insight Investment Advisors, LLC, a registered investment advisor. This podcast is only intended for clients and interested investors residing in the states in which we are registered to provide investment advisory services or exempt from registration. Please contact us to determine if the firm provides investment advisory services in the state where you reside. All content on this podcast is for informational purposes only and should not be considered investment advice. Material presented is believed to be reliable sources, and no representations are made by our firm as to another party's informational accuracy or completeness. Insight Investment Advisors, LLC and its representatives do not provide tax or legal advice, and nothing herein should be construed as such. Always consult with your tax advisor or attorney regarding your specific circumstances. Hello, everyone, and welcome to the Retiring Real Estate Investor Podcast. We are back. Here we are again. I'm excited to be joined by Fred Moskowitz is with us today. Fred and I are going to talk a little bit about, note investing today and dig into that. Before we do that, Fred, I want to give you a platform and a stage to sort of introduce yourself to our listeners.
Yeah, thank you. Thank you so much, Brandon. It's a pleasure to be here. My name's Fred Moskowitz, and I'm known as the alternative investment expert. And my mission is to teach as many people as possible about the different strategies and concepts that we use, all focused around buying and building assets that generate cash flow for you. And so my main focus in my business is through note investing, where we are buying existing notes on the secondary market and holding and owning them for cash flow and income. And I feel that this is something that really ties in very well to the theme of your podcast, which is the retiring real estate investor, because so many of the investors and conversations that I have, it's people that they're saying, hey, we did really well owning properties for many, many years. And now we're looking at note investing as a great transition point and way to pivot.
That's awesome. I think we talked a little bit about pre-show, exactly that, as investors are making that transition. How do you talk to me about sort of the thought process as those investors are making that transition? What do you find is hard for them? What's easy in making that switch? Because it's definitely something different for them. For sure, right? It
is. Absolutely. Let me start by just giving a brief overview about what is note investing, right? I talk to so many investors, Brandon, and we can look at it from this perspective. A lot of people, they know about investing in real estate, and there's all these different asset classes. You have single family houses, you have commercial property, you have multifamily, you have vacation properties and short-term rentals and all of that. But what about if we instead talk about investing in the paper? So we're investing in the capital stack, which are the notes and mortgages associated with all of those properties. And what I found is that this is a really interesting part of the real estate business. And a lot of real estate investors, they don't pay any attention to it. Most people, when they think of a note and a mortgage, they think about being the borrower and not as being the lender. But what happens with note investing is it allows you to step across the aisle and become the bank. And so when you do that, you transition from being the one making the monthly payments to being the one receiving the monthly payments. And so what this does is it really is a great way to increase the predictability of your cash flow. That's what note investing is all about in a nutshell.
When we talk about, I think one of the misconceptions maybe when we talk about note investing is we're like, oh, it seems kind of like an opaque concept in that, well, the bank does that. or
They
Fannie
do.
Freddie does that. Like, well, how do I get involved? Like,
They do. Yeah.
what is my spot where I step in? Like, am I a bank? Like, how do I do this? Like at the basic level, how does someone get involved in this space?
Yeah, that's a great question. There's two ways to get involved in note investing. There's an active investing approach and there's a passive investing approach. And I'll talk about both of them. Active investing approach is where you're going to be really hands-on. You're going to go out to the secondary market, find notes to buy, perform due diligence on them, and then build a portfolio, buy those notes, get them set up with a loan servicing company, and you're building a portfolio over time. That's the active approach. For someone that has a lot of time, this is a great way to go. Now, for someone else, that may be more appropriate to be passive as a note investor. And to do that, you would invest in a managed note fund. And what a note fund is think of it similar to real estate syndication, where the fund managers, they put together a private offering, they go out and raise capital from investors, pool all that capital together, and then they'll go out to the secondary market and buy notes in bulk quantity. And the advantage there is because they're buying in bulk quantity, now they can negotiate better pricing, better discounts. They have economies of scale with the management and admin and managing that portfolio. And for the investors, the passive investors that are limited partners, they get to leverage the expertise, the experience, the relationships, the access to notes in return for receiving a passive cash flow each month. And so for someone that might be investing out of a retirement account or where it has to be a passive investment, it's a great option. But those are the two ways to get involved and to get started. But I always start with the question of, are you active or passive? And that goes right along with how much time do you have? Because this is an active business. So if you're going to be active, you have to treat it like an active business and dedicate the appropriate amount of time to it.
Yeah, when folks are trying to make that decision between active and passive, the time's a big component. And then you touched a little bit on the secondary market.
Yes,
that's not the same thing as if I'm going to buy Apple stock in my interactive broker account where I click a button and I've got it. Or is this a little bit more complex? Can you talk about just access and that secondary market? How does that work?
Yeah. Well, I'll give an example that will resonate with everyone. Have you ever bought a property or refinance a property where you take out a mortgage, you sign all the loan documents, you go to closing, and then you start making your monthly payments, and wouldn't you know it, maybe 2 months later or 6 months later, you get a letter from the lender saying, "Dear Mr. and Mrs. Homeowner, we're writing to let you know that your loan has been sold. Here is the new lender's contact information and address. And starting next month, please send your payment to them. And by the way, don't worry, none of the terms of your loan have changed or the interest rate or anything. That's all the same. So don't worry. However, please start making your payments to the new lender starting next month." And what happened there was that the loan was sold. It was sold, likely it was sold at a discount, which means less than the amount owed on the loan balance. And this happens all the time. That's the secondary market. Loans are bought and sold every single day. You can go on Fannie Mae, Freddie Mac's website, which will, they publicly disclose all the loan sales for the previous quarter that they've sold. And these end up getting packaged into mortgage-backed securities and Wall Street products. And then after a few years, that instrument is collapsed and all the loans get sold off again. And so this a loan will change hands multiple times throughout its life. And for individual investors, you can go to the secondary market. You can buy 1 or 2 loans or 10 or 100, however, you're only limited by the capital that you have. And so that's a big part of it. Now, how does someone get access to that, right? There's not any centralized location or place online, for instance. Really, it's about you have to establish personal relationships with loan sellers. And so that means you have to get involved in the industry, get involved in the investor community, attend events. A lot of things are done through personal relationships. And once you have a good track record of being able to perform and close on loans, then more business will come to you over time, because people like to do business and transactions with those that can do business well and make for a smooth transaction. And so that's a big part of it. But for someone getting started, it's a little daunting, because people don't know where to go, where to start. You have to start by meeting other investors, attending events, and over time you can build those relationships. That's a big part of what we do in this business, for sure.
Gotcha. So yeah, there's some legwork to do there before you can start making those investments. Are those typically banks, like local and regional banks? Is that a fair? You mentioned start with investors and attend some conferences, get some education, like way before that, right?
Oh yeah,
Let's step this out if you want to be active, right? Educate yourself on what you're doing. 1, 2, events, other investors. 3, is that usually end up being the actual person I'm going to source it from? Is that going to be a bank? Is it more likely to be local and regional? They're looking to sell those, or where are those kind of sources in the secondary market?
Yeah, local and regional banks for sure. The big banks, they won't sell simply because they do sell loans, but their transaction sizes are huge. They're selling thousands and thousands of loans in a pool at once. So for most investors, that's not appropriate. But absolutely, local regional banks, they sell loans all the time. And so if you get to know the people that you're going to have a direct relationship, then there's opportunities there for sure. But we buy so much from other note funds, from other note investors. That's the main source of deal flow that I've had success with. But absolutely, these are all different options and ways to approach it.
Got it. Now I'm super curious, because when you mentioned the example of when your mortgage personal level sold, like, yeah, that's me. I raised my hand for those folks watching. Like, that happened to me. Like, it changed.
Yeah, it happens to everyone.
Who's that first buyer? Now I'm just curious how this flows. Like, who are those first buyers of the notes after origination? Is there a way to characterize them of who and what they are?
They're usually some type of bond or a mortgage-backed security that's set up as a trust. And so all you would see on the documents is such and such trust number 52781 or whatever. Yeah. So it'll have a kind of a cryptic sounding name, but that's what it is. And those are very large, and those usually are mortgage-backed securities.
Gotcha.
Yeah.
Yeah, I was going to ask about that. For our longtime listeners, I spent a lot of time at a hedge fund, and one of the things I got to deal with during the financial crisis was RMBS. So I was curious, like, how big is that market now, back and alive? Or are we securitizing a lot of mortgages at this point, or is it more fragmented in where these mortgages sort of end up? Do they end up sort of everywhere at this point? How does that market look like as far as MBS is concerned?
They usually, mortgages will end up in those securities in the beginning, usually shortly after origination. And then the further away you get from origination, then it fans out a lot more.
I got you. So you mentioned that you've had success buying from other holders of notes.
Yes.
Walk me through that. Like, what does that sort of process look like? Are those, I'm thinking about motivations of those folks. Is there motivation to churn capital and to
Yes.
continue to invest in new notes? And then you're there
Exactly.
as a next step in that sort of capital life of the note, right? We started at origination, it
Mhm.
got sold, it gets sold again. You're that next step of selling again after the first sale from origination. Is that sort of the general way to, so I should think about that?
Yeah. Or multiple levels
Oh,
removed. Yeah. But absolutely, it's all about recapitalization
mm, I got you.
and the timing. And a note fund, a mortgage note fund might be closing down at the end of the year. The fourth quarter of every year is a very busy time for transactions. A lot of opportunities come up.
Got it.
And it could be that a portfolio is getting closed out and wound down, and they have to liquidate all the assets. It could be that an investor needs to recapitalize because they're going into their next transaction. And so the notes they've been holding for several years, they can sell those. Notes are very liquid
Mm,
instruments. A note can be sold in the matter of a couple of days. If you have an existing relationship in place between the buyer and the seller, that can go very smoothly and get done quickly. And I always say this, it's a lot faster to sell a note than it is to sell a piece of property,
mm,
right? Think about that. You
mm,
put it up for sale, you get it listed with an agent, and it goes on the market, and then buyers come and make offers and they have their inspections, and maybe there's a mortgage contingency, and you're looking at 2 to 3 months usually between all that time. And
mm,
but with a note, it can happen very quick, within days. So it's a very liquid type of asset. And which is great when you're in that situation where, hey, we need to raise capital quickly
mm.
for our next deal, our next opportunity. And it's all about that time value of money and velocity of money. And that's what's at work there, those forces.
We underrate the need to churn capital from the larger the folks that have a large amount of capital. They do have a need and desire to churn that. We underrate that. So liquidity lives somewhere between. It's not as easy if I want to buy, Apple stock, but it's definitely not as hard as if I want to sell a home. There's somewhere in between that. Sounds like it's closer to transaction in public markets. It seems like it's closer to or more relative to that than it is toward trying to sell property.
Yes.
Um, Curious then, how do you look at notes that you're looking to buy? Like, what are the sort of characteristics of notes that you're looking to purchase? What makes a note attractive?
Wow. There's so much there. So first of all, to start with that question, you have to look at what's your risk tolerance, which
Mm,
is different for each investor, right? It has to do with um, how much experience you have. Do you have a lot of experience in investing, or is note investing brand new? Is this your first deal? Your risk tolerance is going to be very different. Um, are there any problems with the note?
mm,
There can be many issues. There can be title issues. There can be problems with having a less than perfect payment history on the note, or the collateral is not pristine, being the property, the real estate that's securing that note.
mm,
Um, there can be any number of things, and as well as the borrower profile themselves. Is it a good borrower? Do they have a strong credit history and track record, or is it less than ideal? And all of those factors come into play, and it will impact the pricing. And so in general, if you want a super safe note that has very low risk and great track record, you're going to expect a lower rate of return on that. And as we go up the ladder of different problems and issues and challenges that you can take on and address them later, you can get a much higher rate of return if you're willing to take on that risk. And so it's a matter of finding where you are and what you're comfortable with. And I always say, for someone starting out, go with the notes that are safer, for sure. Get some experience, get your feet wet, get established in the business. And then over time, then you can be more knowledgeable and more savvy about how to address different problems, and you'll have the right team members to help you, support you with that. And then at some point you can take on more challenging notes and do well with those. Yes, there's more risk, more problems, but now you're in a better place to mitigate that risk. And so that's part of the evolution of an investor, of a note investor. Even with real estate, it's the same thing. As you get more experience in real estate, then you're able to take on more problems, more challenges, and still do well with that.
During that life cycle of the note from an active perspective, as an investor, what's my responsibilities? What can go wrong? How do I think about what can I actually do to infect or impact the value of that investment? Like, what are my steps? How active is active when I'm a note investor?
Yeah. Great question. So first of all, when you own a note, one of the most important things that you would want to do is to board that note with a licensed loan servicing company. And so a loan servicing company, what do? They're a very valuable vendor for our industry, and they play an essential role. They will manage the note and do the hands-on work on a day-to-day basis. That means they collect the payments from the borrower. They will keep track of the accounting on the note, of the amortization schedule. They will take phone calls from the borrower. They'll send out all the different compliance letters and notices that have to be sent out by law. They will handle questions and phone calls from the borrower. They will also handle, if there's going to be a loan payoff, they'll generate that payoff quote, coordinate with the title company, and take care of all of that. And so loan servicing companies, it plays a vital role. I would never, ever advocate for someone to service their own loans, because it's just not worth it. It's like this. The same way a property manager manages a rental property on behalf of the property owner, the servicing company manages the note on behalf of the lender. And they do all of this at a very low price. Usually it's between $15 to $30 a month for each loan. That's what they charge the lender to service the note. So it's a very low cost. And once you have this in place, it can really allow you to scale up a big portfolio, because now you can manage hundreds and hundreds of notes very easily and quickly scale that up. So that's a very important part of being active, is having that in place. Now, beyond that, here's some other things. There are always going to be threats to the lien. At all times. And I'll describe some of these threats, and now things may make sense. For instance, taxes have to be paid. Mm-hmm. Insurance has to be kept on the property. If the property's in that there's an HOA, homeowners association, those dues have to be paid in a timely manner. Mm-hmm. Think about this. If taxes don't get paid, then the municipality will lien the property, and they can take the property to sale. And usually that's going to jump in priority in front of any secured lien holders, mm-hmm. and could wipe out the mortgage. And so this is why lenders usually require that taxes are paid out of escrow, because they're going to make sure that their lien is protected, and that the taxes, the insurance, all that is being paid. And if the borrower doesn't pay it, the lender, by right, this is in the loan documents by right can go pay the taxes and then add that to the loan balance. And so you know that lenders take all of these steps, and all of the reason for that is to protect their secured interest in the property.
Yeah, I actually, ironically, I've actually participated in a few tax lien auctions. So I was going to ask you about that. Is that when you're thinking about some of those risk points, taxes, insurance, etc., are those different on a by state basis that you think about that? Or
Yes.
ultimately, does it really matter? At the end of the day, if you don't pay your taxes, we're gonna have a problem one way or another.
Oh yeah,
Different by state.
that won't change by any state. There's going to be a problem.
I've learned is different, right? Like here in Wisconsin, where I am, we don't do tax lien sales. We do sheriff sales, right? Like the county will actually, your county, your same municipality will actually take the property, juxtaposed to our neighbor South Illinois, who's a huge tax lien state, who sells those and actively sells those in a market. So those are different. But I guess
when a buyer buys those tax liens in those states, they can force a sale of the property after some amount of time. They can foreclose, and depending on the state, it may wipe out the liens.
Yikes.
So a lender's never going to let a property go to sale. They can step in the day before sale, reinstate all the taxes, and protect their position. And now they get to add that onto the loan balance. That's what will happen in reality.
Got it.
So usually when you see a property actually be sold at tax sale, most of the time there wasn't a mortgage, or there was a mortgage, but the lender's not in business, or some type of situation where someone was not paying attention.
Gotcha.
And so but it rarely happens.
Yep. And this is further to support the point of having a good servicer, right? A servicer should get these notices, handle these issues, and bring those issues to your attention, correct? Yeah. So you can do something about it. So and the service, frankly, I was surprised at not to ruin this for folks, but I'm surprised that the servicer fees that doesn't seem too bad. I mean, this sounds like a really great property manager at a deep discount. Sounds like what you have with a servicing company. Sounds like they're doing doing a lot of this work.
They do. And servicing companies handle thousands and thousands and thousands of loans, very high volume. And they're good. They have their processes, their systems set up. So they do really, really good job. Yeah. And it's a very low cost for the service you're getting.
Gotcha. So for someone starting out and thinking about going active, what sort of things should they look for in the loan? Should they really be looking at, again, let's imagine that I have a little bit more of an aggressive risk profile. Like I kind of do want to make some money here instead of the steady cash flow. Should they be looking at distressed options? And then what does that sort of look like in terms of the distress? How should they think about going about that diligence on that note? Because we already know we have a problem, right? How do we know if that's going to continue to be a problem, or if it's a temporary thing, or how should folks address that?
Yeah, that's a great question. Personally, I like buying loans that are not distressed, that they're being paid on and have a good track record. But with any loan, it really doesn't matter whether it's distressed or not. You're going to be looking at these same things. You're going to be looking at the loan documents, the lien position, the payment history and track record on the loan, as well as the property value. What's the equity position? Is it in a strong real estate market? Is it a rising or a falling or a stable market? What about the borrower? You're going to be looking at their credit history and their track record and their general financial stability as well. These are all areas to look at. And then there are state to state nuances. So you want to be familiar with the particular state where the property is located, and have a good member of your team, that an attorney in that state, right, advising you. You would have a relationship with an attorney in that state. They can provide a lot of guidance and advice for you especially if there's a default or distress situation. Um, and so that's the way to approach it, because every state is different. And so you end up building relationships with legal counsel in every state where you have notes.
Do you find startup investors in the space focus on one particular state that maybe they reside in, or are you finding that there are specific states that are frankly more attractive? I'm sort of thinking about this in the tax lien sort of lens, where that was homework that we did, was to find the states that we wanted to participate in first, and then kind of go about building a business that way, or building investments that way. Is it the same here? Should I think about it the same way?
You can do that for sure, and a lot of times it comes down to familiarity with investors. For us, we buy nationwide, all 50 states, and we're buying loans in pools, so it will just come in as a pool of however many loans, and they'll be spread out over different states. So there's no right or wrong answer there, but for sure that's common to do that, to focus on either the state where the investor is, or specific states.
Gotcha. Now I'm curious. You mentioned buying it in a pool, or a pool of notes at a time. I'm very curious how you start to think about due diligence there. Is there a top-down look that you're doing there first, and then is it working through note by note in some of those cases,
Yeah.
or the pool's so big that, gosh, man, we're gonna have to figure out the note by note later, but I want the pool. How do you sort of think about that?
Yeah, as you get larger and larger, you do have to use more tools and automation to help. But I would say, yeah, you're looking at every note in detail. And so you have to budget the appropriate amount of time to do that.
How big are those pools? How many notes are we talking about?
They're all sizes. Pools can be thousands of notes, or 10 or 5.
Mm.
Um, we've seen it all. Yeah.
Depends on what folks are looking to do. What's the current sort of state of affairs? Because we read a lot of headlines of, oh no, banks are going to have, all these bad loans related to commercial real estate. What they really mean is office, and they mean that folks are going to need to refi, especially on investment properties over the next couple of years, are going to be in for a little bit of a sticker shock, as rates are much higher than they were the first time they took out that loan. Is that impacting the way that you're looking at notes? Are you then seeing more? I know you mentioned staying away from some of the distress, but are you seeing more distress? Is that real, what we read in the headlines, or is it business as usual more for you guys on the note side?
Well, we're not seeing major amounts of distress in the market right now, at least not at this time. But if you think about it, there's always, excuse me, there's always some amount of distress in the marketplace. If the real estate market is very strong, a borrower is able to quickly get out from under a problem with a loan by just selling the property, especially if they have a lot of equity. You can just turn around, sell the property, pay the loan off, and that's it. And so we're in a strong market still. And so the distress, I don't think it's there, but we do hear a lot about what's going to be happening moving forward, exactly the scenario where there's commercial loans resetting at higher rates. And so we'll see how that goes. But there's a lot of forces at work. There's always the potential for government intervention of some type. And whether you agree with that or not, this is a whole separate argument, but it happens.
Mm-hmm.
And so the federal government, they're always going to take steps to keep things as stable as possible, in line with their mission, their stated mission. Mm-hmm. And so it remains to be seen. We're in a wild time of interest rates and just all these different factors, and just know that at any moment, there could be some kind of initiative to backstop any kind of panic or any activity that causes drastic ripples in the marketplace.
Mhm. Yeah, we have to watch out for that. Does simply the lack of origination or the drop in origination in loans, is that impactful to the business in and at itself, regardless of the distress or lack thereof of distress?
It Not so much. It is impactful for those on the front lines in the origination space, for sure. I mean, we're seeing a lot of contraction there and reduction of jobs in loan processing and originations. But for the rest of the secondary market, not so much. Loans are still being bought and sold and traded. That doesn't change. Um, what we will see is the lifespan of a loan will start to stretch out a little longer. Traditionally, it's always been between 5 and 7 years for a residential loan, the lifespan of it. But hey, if someone's sitting there with a residential mortgage at 3% or 2.75%, that's a huge incentive not to sell that or refinance that property.
Mm-hmm.
And so maybe some people will end up staying longer than otherwise because they don't want to give up that financing. And so you have some of that at work as well.
Mm-hmm. Yeah, count me in. I'm never leaving. I'll be my home for the rest of my life. All right, so let's imagine we've gone through this. We've talked a lot about being active. So let's imagine the investors start looking at this and going, that sounds cool, but no, I don't want to invest the time. I'm interested, but not that interested. How can I go about being passive in the space?
Yeah, that's a great question. And Brandon, I see this all the time. Just like the theme of your podcast, real estate investors that have held properties for many, many years, they want to get out of the properties, out of the management and all of those responsibilities, but they still like the cash flow. And so a great option is to become a passive investor in notes because you invest your capital and you're still earning a nice rate of return. And there's so many different note funds out there. There's note funds that focus on residential properties. There's note funds that focus on hard money lending for real estate investors. That's what they do. And there's note funds that go after commercial properties or distressed debt, all different areas. And it's about finding, again, what's your risk tolerance and what kind of rate of return are you looking for? If you want a high rate of return in the double digits, then you're going to be looking at riskier types of note funds. Maybe they're doing hard money lending or short-term loans, different things like that. Or do you want to be somewhere in the middle where it's more residential focused? There's no right or wrong answer, and there's many steps in between, many flavors. And so it's a matter of building the relationships, evaluating note funds, and seeing what's a good fit for you, and also looking at the management team. Are they people you want to work with? You're going to be entering into a long-term relationship, so make sure that it's with people you have a good rapport with, and you're going to have a great relationship moving forward. Because the best thing that can happen is things will go well, and the note fund may end up completing or closing down, but then there'll be another one, and so you can get into the next deal because you already have that relationship in place. And so that's something I always advocate is this is a relationship based business, both on the trading and acquisition side and also with working with investors as well.
Yeah, it's real important that this is very interesting because there's a lot of similarities here, and one wouldn't think it to oil and gas. And the perception there is that all oil and gas drilling is risky. It's like, no, you actually can take bites of the apple up and down the risk spectrum depending on what fits for you. I think maybe the converse would be the prevailing wisdom here, that this is pretty vanilla and plain, but if you really wanted to go after something on the higher end of the risk spectrum, it sounds like you could do that. If
Yeah.
you felt the need to really chase distressed office. Is there a distressed office debt fund? That seems like it'd be the riskiest thing you could probably find, right? You could
Yeah.
probably chase that if you wanted to. So
You
again,
could. There's notes on every kind of asset. There's aviation debt, even if
oh
that
boy.
was, or notes on yachts.
Oh, is that
Uh,
the top end? What's the top end of the risk
car
spectrum?
debt, auto debt. I
Auto
mean,
debt.
these are medical debt. All of that
Oh,
is credit card, consumer debt. All of those loans are bought and sold
oh.
every day.
Is
Yeah.
that the winner on the risk
So,
spectrum? Is it personal credit card debt?
well, that's unsecured. That's unsecured debt.
Right.
So that's a different scenario, different game. I like to focus on residential mortgage loans, which are all secured, or they're all secured loans, and so you have an asset backing your investment.
Mhm. Big difference between asset backed and not asset backed lending. Two different worlds and spectrums. People need to think through
Yeah,
that as well. Correct. Big time.
yeah,
Yeah. It's interesting. Yeah, there's bites of the apple up and down the spectrum. So figure out what and I love what you said about the management's critical and that this is a personal business. And so you need managers in this space that have earned those relationships and continue to work those relationships. That's a really
yeah.
important
It's
thing to
very
evaluate
important.
here, right? I can
It
take a look
is.
at a fund on surface and say it does this, but then it's the next step to me figure out if the management can do that well and has done that well before, right? Is that how folks should look at it?
Yeah, absolutely. You look at track record. What have they done? How long have they been in the industry? What kind of a reputation do they have? I always tell people when you're looking at an investment of any type, any fund, any deal that you might be looking at, yeah, you look at the numbers and the deal itself, right? But also don't forget, look at the people, who's involved, what's their background, their track record, their history. Are they reputable? Do you like them?
Yeah.
Would you go out? Like, would you mind going out and have lunch with them from time to time? No, seriously,
Yeah.
because who wants to do business with people they don't like?
100% no one.
Exactly. And this is a long-term relationship, just like a marriage.
Mhm.
And so do your due diligence up front and make sure you're comfortable getting into a long-term partnership, and do that before,
Yeah.
not after. Because when things are great, everything's good. But what about when there's a problem? How does someone respond and handle that?
Mhm.
Problems come up. It's a part of life.
Mhm.
And so what is it going to be like when there's an issue and it has to be resolved? And how do you work through problems? How do you communicate with your investors? These are all important questions to ask. And it's something not to be taken lightly.
Yeah, Fred, you're taking a page out of our kind of due diligence playbook. I recently just posted something last week about, you know what, sponsors and syndicators and fund managers, investment returns are really important, and we sort of need them. But right after that, in secondary importance level, is how you communicate with your investor class. Sending K1s out on time is pretty darn important. Communicating and updates is pretty darn important when things are going bad, good, or otherwise. You got to let people know, and you got to let them know in a timely fashion. They want that. They need it.
Yeah.
And I do. We get it from investors all the time. Even some of the best performing investments we have for folks, when they're not happy about the communications, they're not happy, regardless if the returns are coming in or not. So these secondary things that we think are secondary things are not, and they are an inflection in a window into the way that a sponsor investment fund company thinks about their investors and how much importance they put on that. That will come back down the road when there is a problem, and that's what we pay for. I was thinking about this too, and you're talking about problems will come up. This is why we invest passively. One's time. I think time's first. Two is returns. But three is I want you to deal with the problems, Mr. Fund Manager. I don't want to deal with them. If I want to deal with them, I'd be active, right? I want you to go deal with it. And how you deal with it is pretty darn important. So you bring up fabulous points here on diligence. Folks really need to be thinking about this. beyond those deal numbers, there's things that are more important than the projections, right?
Yeah, you could have the best deal on the planet, and if it's not managed well, if the communications with the investors isn't good, then the customer experience from the investor's perspective, it's not going to be a positive one.
Mm-hmm.
It's not. And that makes a huge difference.
Absolutely. Fred, what haven't I asked you that I should have? I feel like I missed something. What did we miss? I feel like we nailed some of this. What did I miss?
We covered a lot.
Nailed it.
We covered a lot. But I would say as a final point is really get to know who you're doing business with, whether you're active in note investing, who are you transactioning with, you're buying from, get to know who they are. If you're a passive investor looking at a fund, get to know the management team, the fund operators, and build a relationship with them. Make sure you're going to be comfortable working with them, because that's going to dictate a lot about how things are going to go.
No, it's beautiful and perfect. Fred, what's the best place for folks to find you? Where can they go and learn more? There's a book out there, right? That they can
There
take a look
is.
at. Tell us all about it.
Yeah, thank you. Thank you, Brandon. Yes, I wrote a book about note investing. It's called The Little Green Book of Note Investing. You can find it right on Amazon. Just look it up by title or by my name, Fred Moskowitz. It will come up. And this provides a nice high-level overview of note investing, both from an active perspective or passive, how to get involved, how to do note investing with retirement accounts. We spend a lot covering that. I feel it's a very important approach. Now, beyond that, I always love connecting with investors, building relationships. And so you can connect with me by visiting my website, which is fredmoskowitz.com. However, if you prefer a little easier spelling than that, you can just go to giftfromfred.com. It'll take you right to my website. And once you're there, I have a really nice special report that I can email to you about note investing, learn a little more about it, how it works. Just go to the website and you can request it there. I'm happy to send that out. And always look forward to connecting with like-minded individuals and investors and learning what you're up to. So please do reach out.
Come get to know Fred. I mean, it's an open invitation here to come and do it. So please do it. We're gonna link all those items up in the show notes so people have an easy way to go and access them. That's a lot of material and it's really good stuff. So we really appreciate that. Fred, thank you again so much for taking the time and coming on. It's an awesome conversation. And
thank you for having me, Brandon.
Awesome stuff. And then thank you all for listening. Until next time, we'll see you.